Welcome back to AI Research. Today, we are analyzing one of the most iconic charts in financial history, the long-term performance of the Coca-Cola Company, Co. To understand the volatile movements between 1987 and 2026, we must distinguish between the lost decade of overvaluation and the sharp, external shocks that defined the later years. 1. The Buffett entry, 1987-1988. While the 1987 Black Monday crash caused a sudden 22.6% drop across the entire market, Warren Buffett saw it as a massive opportunity. The cause, systematic panic and program trading, caused the 1987 drop. The move, Buffett waited for the dust to settle and began buying in 1988. The price, he entered at a modest price-to-earnings (P/E) ratio of approximately 15x. His total investment of $1.3 billion has since grown to be worth over $25 billion as of 2025. 2. The lost decade, 1998 to 2014. As shown in your chart, the stock peaked in 1998 and then went nowhere for 16 years. The cause, extreme overvaluation. In 1998, Co traded at a 50x P/E ratio. The outcome, the stock didn't consistently break its 1998 high until 2014. Teaching investors that paying too much for a great company can lead to zero returns for decades. 3. Modern shocks, 2008 to 2024. The following analysis covers the specific dips you requested based on historical market data. Year. Event, cause of drop. Context: 2008. Great Recession, global credit crisis. Co's revenue actually rose 11%, but the stock fell as part of the broader market sell-off. 2020. COVID-19 pandemic. Lockdown closures of away-from-home channels, stadiums, theaters, caused organic sales to fall over 25% initially. 2022. Inflation and rates. Rising input costs, aluminum, sugar, and interest rate hikes pressured defensive stocks. 2023. GLP-1, weight loss, panic. Investor fears that new weight loss drugs would permanently reduce soda consumption led to a sharp mid-year dip. 2024. Tax litigation and volume. Co faced a $6 billion IRS tax deposit and a surprise 1% drop in unit case volumes late in the year. Full analysis summary. Coca-Cola remains a dividend king, having increased its payout for over 60 consecutive years. However, the chart proves that even a safe haven stock is not immune to valuation bubbles. 1998 proved that no brand is worth any price. External shocks, 1987, 2008, and 2020 show that global panics will drag down even the best businesses. Regulatory, health risks. The 2023-2024 period highlights modern challenges like tax disputes and health-conscious consumer trends. Today, in 2026, Co trades at a much more reasonable P/E of roughly 22x-23x, far from the dangerous levels of 1998.